Hello students, today we will learn few more topics in catering management, that is break-even analysis and variance analysis. We will see how to define and explain break-even point equation, to know how break-even point is calculated by formula or methods of estimating break-even point, to know what are its advantages, assumptions, characteristics and limitations of break-even point, to define and explain variance analysis, to know about different types of variance analysis, to know what are its advantages of variance analysis. The break-even point and break-even chart are two byproducts of break-even analysis. In a narrow sense, it is concerned with the break-even point, and in a broad sense, it is concerned with the break-even chart. Break-even analysis is also known as cost volume profit analysis. The analysis is a tool of financial analysis whereby the impact on profit of the changes in volume, price, costs and mix can be estimated with reasonable accuracy. Break-even point is equilibrium point or balancing point of no profit, no loss. This is a point at which loss ceases and profit begins. This is a point where income is exactly equal to expenditure. Break-even point is a point where the total sales are equal to total cost. In this point, there is no profit or loss in the volume of sales. Now coming to variance analysis, in budgeting or management accounting in general, is a tool of budgetary control by evaluation of performance by means of variances between budgeted amount, planned amount or standard amount and the actual amount incurred or sold. Variance analysis can be carried out for both costs and revenues. This is essentially concerned with how the difference of actual and planned behaviors indicates how business performance is being impacted. Material variances arises from the difference between actual costs of materials used in production and standard costs of materials specified for the goods produced. Labor variances denotes the actual wage paid to the workers versus the standard wage prevalent for the output specified. When the actual labor costs are more than budgeted ones, the variance is unfavorable. Overhead variances may be defined as the sum total of indirect material, labor and expense costs. Overhead variances may arise due to the difference between standard overhead costs budgeted and the actual overheads incurred. Coming to definition of break-even point, it is defined as the business volume that balances total costs with total gains. At break-even volume, in other words, net cash flow equals 0. In the simple analysis, break-even is the quantity or unit volume that balances total costs with total gains for a net cash flow of 0. The break-even quantity depends on three variables, that is fixed cost, variable cost per unit and revenues per unit. Break-even analysis attempts to find break-even volume by analyzing relationships between fixed and variable costs on the one hand and business volume, pricing and the net cash flow on the other. Understanding how these factors impact each other is crucial in budgeting, production planning and profit forecasting, and break-even analysis is central to this understanding. The basic components of break-even analysis normally include fixed costs and variable costs and semi-variable costs sometimes. Coming to fixed costs remain fixed or constant regardless of unit volume. For example, if the costs of floor space, manager salaries and janitorial services do not change with volume, they are fixed costs. Coming to variable costs vary in direct proportion to quantity sold or units sold. The variable costs for selling goods, for instance, might include the direct costs the seller paid to acquire each unit. As a result, the total variable cost can be simply cost per unit multiplied by the number of units sold. Semi-variable costs. These are constant across a range of business volume levels, but change when volume goes out of range. Coming to the calculation of break-even point. Break-even point as unit volume. In business, the term break-even point usually means the unit volume that balances total costs with total gains. For the analyst, break-even is the quantity Q for which cumulative cash outflows equals cumulative cash inflows. Simple break-even analysis finds Q by analyzing relationships between just three variables, that is fixed costs, variable costs and incoming cash flow. Additional factors must also be considered, however, when semi-variable costs or variable pricing are present. Catering being labor intensive, the fixed costs are generally higher than variable costs. When variable costs become higher, example, when certain foods used are out of season or the customers increase, the fixed costs per cover decrease, bringing down the contribution too. Coming to the benefits or the advantages of break-even analysis. The main advantages of break-even point analysis is that it explains the relationship between cost, production, volume and returns. It can be extended to show how changes in fixed cost, variable cost, commodity prices, revenues will affect profit levels and break-even points. Break-even analysis is most useful when used with partial budgeting, capital budgeting techniques. The major benefits to use break-even analysis is that it indicates the lowest amount of business activity necessary to prevent losses. The break-even analysis depends on three key assumptions. Firstly, the average per unit sales prices, that is per unit revenue. This is the price that you receive per unit of sales. Take into account sales, discounts and special offers. Get this number from your sales forecast. For non-unit based businesses, make the per unit revenue $1 and enter your cost as a percent of a dollar. The most common questions about this input relate to averaging many different products into a single estimate. The analysis requires a single number, and if you build your sales forecast first, then you will have this number. Second is the average per unit cost. This is the incremental cost or variable cost of each unit of sales. If you buy goods for resale, this is what you paid on average for the goods you sell. If you sell a service, this is what it costs you per dollar of revenue or unit of service delivered to deliver that service. If you are using a units based scales forecast table, you can project unit costs from the sales forecast table. If you are using the basic sales forecast table for retail, service and distribution businesses use a percentage estimate. Coming to monthly fixed costs, technically a break-even analysis defines fixed costs as costs that would continue even if you went broke. Instead, we recommend that you use your regular running fixed costs, including payroll and normal expenses. This will give you a better insight on financial realities. If averaging and estimating is difficult, use your profit and loss table to calculate a working fixed cost estimate. It will be a rough estimate, but it will provide a useful input for a conservative break-even analysis. To see the limitations of break-even analysis, it is best suited to the analysis of one product at a time. It may be difficult to classify a cost as all variables or all fixed, and there may be a tendency to continue to use a break-even analysis after the cost and income functions have changed. Next, we will see about the variance analysis. In this, we will learn about material, labor, overhead and sale variances. While the standard recipe and the standard dish costing sheet lays the targets for profit margins to be achieved if they are followed meticulously and calculated accurately, in practice, this is not so. Differences occur because of price fluctuations or changes in the amounts of ingredients actually used due to differences in weighing and measuring equipment and methods which different people use in an establishment. These differences are known as variances and may be either adverse or favorable in items of the effects on the profit of the establishment. The function of standards in cost accounting is to reveal variances between standard costs which are allowed and actual costs which have been recorded. Variance analysis can be defined as the process of computing the amount and isolating the cause of variances between actual costs and standard costs. Variance analysis involves two phases. One is computation of individual variance and second is the determination of the cause of each variance. Material cost variance. Material cost variance is the difference between the actual cost of direct material used and standard cost of direct materials specified for the output achieved. Now, this variance results from differences between quantities consumed and quantities of materials allowed for production and from differences between prices paid and prices predetermined. This can be computed by using the following formula. Material cost variance equals the actual quantity into the actual price minus the standard quantity for actual output into the standard price. An adverse material yields variance would indicate a loss of proportions through wastage, overcooked or pilferage. This reason can therefore be located and corrected to control profits. Cost variance includes both material and labor variances. While material variance refers to price and usage deviations, labor variance involves the rate and efficiency deviations and are useful guides in determining the relative usefulness of installing time and labor saving devices in work centers. Labor variances. Since catering is a service industry, labor or staff costs form the largest expense next to food. Labor costs include salaries of the staff and the value of all benefits provided to them such as meals, medical facilities, housing, insurance, bonus, pension and uniforms. Controlling labor costs therefore involves control of expenses in all the areas listed, which is difficult because of the relatively fixed nature of the cost. Direct labor variances arise when actual labor costs are different from the standard labor costs. In analysis of labor costs, the emphasis is on labor rates and labor hours. The variance is calculated by using the following formula. Labor cost variance equals the actual hours into the actual rate minus the standard hours into the standard rate. Overhead variances. Overhead variances include all costs which cannot directly be identified with food products. These include rent, rates depreciation, fuel, cleaning materials, administrative and selling costs. Of these costs, some are controllable and some are beyond control or uncontrollable. The analysis of cafeteria overhead variances is more complex than variance analysis for direct materials and direct labor. There is no standardization of the terms or methods used for calculating overhead variances. For this reason, it is necessary to be familiar with the different approaches which can be applied in overhead variances. Sales variances. It is the difference between the actual value of sales achieved in a given period and budgeted value of sales. There are many reasons for the difference in actual sales and budgeted sales, such as selling price, sales volume and sales mix. Sales variance can be calculated by using any of the following two methods. One is the sales variance based on turnover. Second is the sales variance based on margin. The first approach, that is sales variance based on turnover, accounts for difference in actual sales and budgeted sales. The sales variances using marginal approach accounts for difference in actual profit and budgeted profit. In the margin method, it is assumed that cost of production is constant, that is, there is no difference is assumed between actual cost of production and standard cost of production. The reason for this assumption is that cost variances are calculated separately to analyze the difference between actual cost and standard cost of production. Therefore, cost side of the sales variance is assumed constant under the margin method. The following are the merits of variance analysis. The reason for the overall variances can be easily found out for taking remedial action. The subdivision of variance analysis discloses the relationship prevailing between different variances. It is highly useful for fixing responsibility of an individual or department or section for each variance separately. It highlights all inefficient performances and the extent of inefficiency. It is used for cost control. The top management can follow the principle of management by exception. Only unfavorable variances are reporting to management. Sometimes the variances can be classified as controllable and uncontrollable variances. In this case, controllable variants are taken into consideration for further action. Profit planning work can be properly carried on the top management. The result of managerial action can be a cost reduction. It creates cost consciousness in the minds of every employee of business organization. Thank you.